Good afternoon and welcome to the Trinity Exploration and Production PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Jeremy Bridgeless-Singh, CEO. Good afternoon to you, sir.
Good afternoon, good morning to those who are joining us today. Thanks for taking some time to listen in to our latest updates on Jacobin, and I'll also describe where we are in terms of the 2023 guidance and the news flow for the remainder of this year into January of 2024. For those of you who are joining us for the first time, let me just quickly recap who we are. So Trinity is focused entirely on Trinidad and Tobago. We produce roughly 2,800 barrels of oil per day, which represents between 5 to 6% of the nation's liquid oil production. We generate a significant amount of cash flow from that production. Our balance sheet, as at the end of September, included $8.4 million of cash and access and undrawn overdraft of $6 million. The board and management team are internationally experienced and have worked across a number of jurisdictions, as well as comprise a range of disciplines that allow the decision-making and the execution of strategic plans to be risk managed. In terms of the near-term growth catalysts, we are focused on Palo Seco and we have Galeota, as we've described in the past, as the more medium-term growth catalyst, which is being worked in the background. Trinity, because we've got existing production, we have existing cash flow. During the course of this year, we described that we would be returning cash to shareholders. That would be in the form of a dividend, and we are committed to paying a dividend of 1.5 pence per annum. And we began that during the interim dividend, which was paid in October of this year. And the remainder of that initial maiden dividend will be paid when the full year results are released in half one of 2024. So getting into the meat of the matter here that I'm here to describe today is where we are with Jacobin. So to recap very quickly, we drilled the Jacobin well. We commenced drilling in March of this year. We completed drilling in or around August, so it took us some time to drill the well. We did have some drilling challenges, which resulted in 3 different sidetracks happening with the well. The well was designed to go through a development leg within the forest and upper cruise zones, which we typically produce from. But we deepened with an exploration leg into the lower cruise zones. And in the lower cruise zones, we found 3 different sets of reservoirs. The lower cruise 1, where there were 2 zones. The lower cruise 2, which was a significantly thick reservoir, but it was largely wet. And then the lower cruise 3. We began well testing at the lower cruise 3. We brought that onto production, but very quickly we encountered issues with sanding within that zone. We cleared the sanding plug, but the pressures in that zone bled down, and we made the decision to move uphole to the 2 lower cruise 1 zones. We've since brought the lower cruise 1 zones onto production. We guided the market that we would have those on by mid-December, and that timetable was predicated on the basis that when we did investigative work, we may have found remedial actions that were required in the wellbore to happen. But when we did the investigative work, it actually led us to understand that the wellbore was in good state, and therefore we were able to set a plug and move uphole and perforate those much quicker than anticipated. So we brought the zone onto both zones within the lower cruise 1 area into production. We got significant pressure at the wellhead when we brought it on, and the well flowed at variable rates, between sort of 80 to 160 barrels of fluid per day, and that comprised both water and oil. But along with that came a significant amount of gas, and that's why we say the rates were varying, because the gas, when it flows, it essentially inhibits the liquids production. So the gas flows for a period of time, and that may be 1 to 2 minutes, and then you have as the gas subsides, then the liquid will flow. So what we were trying to do at the wellhead was to utilize a means of trying to choke the well at varying sizes of choke to try and get the point that we would get enough gas to lift the oil, restrict the water that was coming in as well, and then produce the oil. We are in the process of trying to fine-tune that. We have implemented other pieces of equipment which are past the wellhead, which are separators, and the separators are essentially there to allow us to produce both the gas and oil, and then separate those and allow a quicker stream of oil to come through. So we're in the process of trying to put those pieces of equipment together. We've also understood that at the wellhead, because of the pressure that is there, alongside with the presence of gas, oil, and water, that an emulsion was forming. So we utilize a chemical, or we are utilizing a chemical to break down that emulsion at the wellhead, so that when it produces into the separators and then into the well side tank, the oil and water separate very quickly. So those are some of the ideas and some of the challenges that we are having from an operational standpoint to get the production in a more stable manner. In order to determine what is happening downhole, we are currently running a pressure test. So we put a gauge into the hole, and we are currently running that across the different zones of production to understand what those pressures are, trying to understand what the pressure buildup will be, and therefore determine where is the production largely coming from, and then use that to correlate against the logs that we have for the well, which define where the hydrocarbons are versus the water, and then make a decision from there as to whether, which zone is more preferred for us, and take a decision as to whether we can produce one zone on its own, or whether we need to look at isolating one, either the higher zone or the lower zone. But we are currently in investigative mode. Is the takeaway from that. I think, when we looked at perforating this well, it was clear from the logs that we saw that there was an oil leg which would have contained gas, and there was also a water leg. So when we perforated the well, we intended to stay away from the water leg, and therefore the water in the production that we see right now is something that we are not entirely clear on. So it may be that the water is coming through the cement job that we've done, and there may be fractures within that cementing. That means that there is some flow of water. Again, by doing further investigation, we'll understand which zone the water is coming from, and then make a decision as to whether we can or want to isolate that, or whether we want to produce that water within those zones. The oil that we produced thus far has been of a very good quality. The API density is measured at 31.7. For reference, the average API rate that we have, or the average range that we have across our onshore production, is somewhere between 23 to 28. So this is at a higher rate, and it also represents, or rather, it demonstrates that with the gas oil ratio that we see, and the gas that we see coming through, helps to move the oil to surface. The gas presence here within this well is also indicative of the lighter quality oil that we are seeing. So where are we now in terms of this data gathering exercise? I mentioned that we are carrying out a pressure test. We have implemented various equipment, such as separators, post the wellhead, and we're utilizing all of that to try and get a good understanding of which are the zones to produce from, how best to produce it in terms of choke sizes, what type of separator we need to put on, whether it is a vertical, horizontal, two-phase or three-phase separator. So at this point in time, we are doing very low-cost activities to understand how we can get the well optimized. And depending on what we optimize, we will then take a decision as to whether this zone is economic to continue to produce from. We spent thus far on this well $8.3 million, of which 6.2 has already been paid. So that leaves a remainder there to be paid of $2.1 million to be paid. And there's an amount that we are in discussion with the drilling contractor about, because some of the costs that we incurred while drilling this well, or the costs that were incurred in drilling the well, were outside of the geological challenges that we found. So we are in discussion with the drilling contractor to determine how best we will treat with those. The intent is that we will settle the full cost of this well without any recourse to external finance. We'll be able to pay this well from the existing organic cash flows that we have. I'd like to take an opportunity to remind everyone about what our guidance for 2023 has been. So we guided early on this year in May, we provided guidance on what our sales, our capex, and operating cash flow would be. Our sales, we guided downwards we guided towards the bottom end of the range to 28 to 2,900 barrels, which was previously 28 to 3,100 barrels. Based on where we are with production, I expect us to come in or around close to 2,800 BOPD. In terms of our capex, 16 to 18 million was the guidance mid-year, and we'll be slightly above that because of the overspend on the Jacobin well. But most importantly, from my perspective, the operating cash flow, we guided between 10 to 12 million. I think we'll certainly be towards the upper end of the range, if not beating that range. And again, looking at sales, looking at capex, I think the operating cash flow is a good indicator of what cash the underlying business, the core business is generating. And notwithstanding, we have invested in an exploration well, which has a significant amount of risk attached to it. The underlying business, which is supported by very low decline production and a low cost structure, is generating operating cash flow, which we are using to reinvest into the business and try and grow, as well as return cash to shareholders. Where we are now in terms of guidance into 2024, we usually provide guidance in Q2 of the year in which we relate to. But next year, I would like to get guidance out to the market in late January of 2024. And that will be predicated on providing a Q4 operational update, which we usually provide in around the third week of January. And that will allow you to see what the full year production is, what the ending cash balance is, and what the operating cash flow is for the year. So that will give you, where we stand in terms of sales and operating cash flow guidance. And that will be provided in the third week of January. And soon thereafter, we'll provide what the guidance is for 2024, which will be comprised of these metrics that you see in front of you. And further to that, the SPT reform that we've seen, and for those of you who are familiar with SPT, you'll understand how material that is for us. For those of you who are not, familiar with SPT, it's almost like a royalty tax on our net revenues. And the government has announced in the budget that was read on the 2nd of October that the SPT on shallow marine fields, the threshold at which the SPT would commence would move from $50 and 1 cent to $75 and 1 cent. So we have been paying attention to that. We've seen that the finance bill has now been written and it has been read in the lower house last week, Wednesday, and it will be read today in front of the Senate. And if that is passed, it will then move on to get presidential assent. And therefore, we look like we are in a very likely position that SPT reform will be enacted as of January 1st, 2024. For reference, in terms of what does that mean for us, this year, the offshore SPT liability is in the range of $3 to $4 million. So that would have been coming out of our operating cash flow. So from next year, once that is enacted, you'll be looking to add somewhere in the range of $3 to $4 million annually in terms of operating cash flow that it would have gone to SPT previously. So I would expect next year, if these oil prices remain where they are, that the operating cash flow from this business should be increasing, even though we may have slightly declining production on the back of no further drilling within the next 6 to 9 months. So at this point, I'd just like to stop and give the opportunity, just to wrap up at this point and say that, where we are with Jacobin has certainly been, from a production standpoint, it's not been the result that we've been looking for by way of flowing barrels. But in terms of the geological understanding that we have gotten, the fact that we have encountered 3 lower cruise zones, 2 of which were oil bearing, has certainly helped to prove up the geological model for the wider Hummingbird play, and more so into the exploration block for the Buenos Aires exploration block that we hope to get awarded within the next month or 2. So Trinity, the Palo Seco area, remains a key strategic option for us, and we'll continue to build the Galeota option in the background. Thank you for your time and attention this morning. Let me turn you back to Alessandro before I go to the question and answer section. Thank you.
Perfect, Jeremy. Thank you very much for your presentation. What I'll do is I'll bring up your camera for the Q&A session. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while Jeremy takes a few moments to review the questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Jeremy, as you can see, we've received a number of questions, both pre-submitted and throughout today's live event. And if I could just hand back to you just to read out the questions where appropriate to do so, provide a response, and then I'll pick up from you at the end. Over to you.
Thanks very much, Alessandro. I've got some of the pre-submitted questions there, and I'll try to run through as many questions as I can. I'll start with the first one. And this first question is, can you please provide a plan with return on investment? Clearly, Hummingbird is a no-go as a shareholder, as it is too risky for any company. Additionally, I suggest that you should not take on any more debt and just run the acreage for cash, which can you please return to shareholders? Is it feasible? If not, are you substantially bankrupt? I'll do that in reverse order. We're definitely not bankrupt. As you can see, and what I've just demonstrated, the company is generating significant operating cash flow. And further to that, at these oil prices, the company will continue to generate those cash flows, and that will be augmented by the SPT reform, which we hope will be enacted on the 1st of January. The business itself is designed to break even from an operating perspective at very low oil prices. Currently, that is in the mid-30s. So therefore, if the oil price was to dip into low 40s, into even low 30s or mid to low 30s, the company would still be able to break even and pay its day-to-day liabilities. So we're certainly not in a bankrupt position. We have cash on balance sheet, and we are able to meet our debts as they fall due. In terms of providing a plan with return on investment, we clearly describe to shareholders, what our plan is. And our plan is to try and take on projects that have, greater cash-on-cash returns, projects that have an opportunity to, the working capital cycle will be much quicker than projects we've been investing in further. And by example, what I mean there is the development wells that we tend to drill and have drilled, in the past, from when I've been with this company from 2012 till present. Those wells are fairly certain, but the production is fairly low. And as a result, when you look at the production versus the investment required, the payback periods tend to be between 3 to 5 years. The project that we attempted to do with Jacobin, which is to deepen to test into the exploration zones in the lower cruise areas, was to try and find virgin reservoirs that would have pressure that would support higher rates of production. And those higher rates of production would then mean that the amount of capex that you spend versus the higher rates of production and sustainable production meant that you had an opportunity to reduce the working capital cycle and increase your cash-on-cash returns. Unfortunately, with Jacobin, that has not yet happened, but certainly what we've understood from a geological standpoint is that the geological model is intact. We've learned that drilling a 10,000-foot well is quite difficult to do, but the range of uncertainty for drilling has now reduced, given that we've gone through that process. So we understand that some of the challenges that we had with the drilling fluids, with the directional tools, and then the lithologies in the deeper sections in terms of mud weights and how we drilled through those, that experience that we've been through has taught us a lot. It has cost us, has cost shareholders a lot of money to understand that. But as an oil company, taking on different types of projects mean that we are taking on risk. Exploration has a certain level of risk attached to it. It's certainly way more risky than the existing production. But what we were trying to do is to change the manner in which we deploy capital and get returns. So the plan is, we will continue to look at further investment into drilling in due course. We are not in a position right now where we're going to make a decision to sanction any further drilling in Jacobin or the Hummingbird or even Buenos Aires at this point in time. What we are doing right now is putting together the opportunity hopper to look at those opportunities, to risk them appropriately based on what we've learned so far, and then make a decision. And alongside that, we will be producing as to reducing the amount of decline for the existing production, managing the cost structure downwards so that we can maximize the amount of operating cash that we generate, replenish the cash and balance sheet, continue to pay the dividend that we've mentioned to shareholders, and then build up enough cash that we can continue to grow the business from organic cash flows. Question 2, somewhat related to question 1. Can you focus on short-term, low-risk, high-return plans now the adventurous ones seem beyond your means? Short-term, low-risk, high-return, within our portfolio, there are not many low-risk, high-returns. The low-risk, high-return projects are recompletions. So recompletions, for example, are when you have an existing wellbore, you're producing from a lower section, and that section becomes uneconomic to produce, and there are uphole sands that you can produce from. So we have, assiduously been going after those, and in fact, over the last 5 or 6 years, we have done around 1/3 of the recompletions on the island, in comparison to any other operator. So we've been very, very focused on doing those recompletions, and the reason for that is because it's low risk, and the returns are such that those projects tend to pay back within months, 3 to 6 months, depending on what type of production we get. So they are very good projects, but as you do more and more of those, unless you have new wellbores to access, then the pool of those start to reduce. So we are in sort of the phase where we are looking at wells that have existing production with recompletions uphole, but we need to get that production level down to uneconomic rates of production before we move uphole. So the amount of RCPs that we used to do, you will see, is on the decline. So those projects are reduced. So therefore, how do we get into higher return projects? Jacobin was an attempt to do that. We've clearly learned a lot. We need to gather our thoughts on that. We need to look at the information. We need to continue the investigative work. And once we've done that, then we make a decision as to what next we will move on to. We would have preferred the $8.3 million to be in shareholder pockets. Consider the need of rewarding shareholders as your main task. We have contemplated that. We've reflected that in our capital allocation decisions. We are returning cash to shareholders, but we also recognize that at 2,800 barrels of oil per day, that is declining. We also need to reinvest into projects that will both stabilize and grow our production and allow us to be here in the longer term, in terms of longer term returns to shareholders and surviving in the longer term. So you will see that the capital allocation hopper, as we described before, will consist of capex that is both sustaining as well as growth, but also we'll be setting aside a certain level of cash to return to shareholders on an annual basis. The next question is, Jacobin has been a major drain on the company resources. Where will you next drill and how will you fund it? Yeah, a really interesting question. I mean, certainly, we did not budget for the well to be costing us $8.3 million. Where will we next drill? Well, now that we have, perforated and we are accessing reserves in the Lower Cruise 3 and now the Lower Cruise 1 zones, I think it's important for us to understand how extensive these reservoirs are. And that's one of the reasons that we're doing the pressure buildup tests currently. That will allow us to understand, what zones are commercial, what zones make sense for us to drill. And importantly, these are within around 7 to 7,500 feet. So these are just about 1,000 feet deeper than we usually drill. And drilling to 6,500 feet tends to cost us between $2 to $2.2 million. So I would envisage that if we were going to 7,500 feet, that the cost of the well would be tending more towards that $2.2 million versus any $8.3 million that we see with this well that was drilled to 10,000 feet, because a lot of the challenges that we had were in getting from sort of 8,500 to 10,000 feet, and that's where we spent a lot of time trying to get to the Lower Cruise 3 zone. So I would envisage that we would gather data, we would then make an assessment as to whether there was any further reservoir potential for us to drill into the Jacobin Lower Cruise 1 zone. But whilst we're doing that, we'll also be maturing the Buenos Aires prospects, and then looking at the opportunities that we have there. And it might be worth me spending a time, a minute or two, and segueing onto Buenos Aires. And Buenos Aires, to remind you all, is a much stronger license because it is not a sub-license where we are seconded to the state through heritage, but this is actually a head license with the state. And the Buenos Aires field is an E&P license. It's pure exploration. There is no production. There are no drill wells within this block. So we, in the first instance, will be looking to investigate and explore within the Buenos Aires block. The royalties that we pay there are only one royalty to the state. There's no royalty to the state oil company heritage. So, and we also have full control in terms of how we operate and how we go about drilling within the Buenos Aires block. So it's a stronger commercial contract. In terms of exploration, we have committed to the Ministry of Energy that we would drill 4 exploration wells. So within the Buenos Aires block, which sits 500 meters away from our largest onshore producing block, which is the WD-56 block. The geology that we see in WD-56 continues and is contiguous with what we see in Buenos Aires. So that's very encouraging. The team has identified a number of fault panels that we would be interested in investigating. In the initial phase and in the last presentation, we described there were 4 fault panels labeled A, B, C, and D, with a range of stope, between 5 to 10 million barrels in each, with stacked pay across the lower cruise, the upper cruise, within the forest sands, the upper cruise and the lower cruise. And I would envisage that we would be, if we were getting into Buenos Aires, once we have the prospects identified and we have the environmental license, which we are currently pursuing, once we have those in place, we would be looking at potentially drilling a well within Buenos Aires in later on in 2024 or early in 2025, depending on what the investigation on Jacobin throws up. The next question is the sand blockage on LC3. The water and emulsion rates of LC1 are certainly price-sensitive issues. According to AIM Rule 11, it requires notification without delay of any new developments which are not public knowledge, which, if made public, would cause a significant movement in the share price. Clearly and undisputedly, this has been the case. Look at the market response to both issues. I declare that you have withheld information from us, your loyal investors, and we have suffered grossly and accordingly, and that you have not abided by AIM Rule Regulation 11. I just want to take the opportunity to reiterate to everyone who's listening today and those who will see this that we as an AIM company must have a nominated advisor with us, and our nominated advisor guides us as to the how we operate our business against all of the AIM rules, the AIM Rule 11 notwithstanding. And throughout this process, and it's a dynamic process in terms of drilling and then testing the Jacobin well, and on a daily basis, a number of things happen, but there are certain milestones that we achieve, and this is what we've described to our nomad, and this is what we've agreed with him, and we've adhered to that plan in terms of at certain times we would update the markets. In fact, the updates that we've been doing within recent times have been above and beyond what is required from a market regulation perspective. So hopefully that goes some way in terms of describing how we go about approaching our regulatory duties. In similar vein, there's another question that says, there has unequivocally been insider selling. One can deny it, but the truth is there to see. The information has leaked. It was your duty to keep information confidential. And only last Friday, there was a 100K share after our sell. One day, 10 days ago, that was a huge sell-off. This has been trading on insider knowledge, unavailable to investors. One can deny it, but it is clear to see. And there's another similar comment later on that relates to price-sensitive information being released in an irregular manner. I just the board and management team that I work with, we hold ourselves to the highest standards of integrity. We adhere to the codes and the rules that we subscribe to, and part of that is making sure that any information that we release is released in an equal manner to all shareholders in terms of an equal timing as well. In no way am I aware of, or within my team aware of, any sort of behavior that is described like this. And in fact, that's not something that this board and management team would subscribe to in any way. A simpler question is, will you be upholding this says 3.5 dividend as promised, but actually we promised 1.5. We paid 1/3 of that in October, and we intend to pay the remainder of that once the full year results are released in H1 of 2024. The next question is, I proffer that you should attempt to sell assets such as Galeota and concentrate on what you can do. You clearly cannot afford Galeota alone. The asset sale could repay shareholders and be used for less risky onshore drills and the Virgin BA drill. I think that's a really interesting question. Certainly, from where we stand, as a company, the organic cash flows that we have, looking at the market reaction to the recent news that we've had and where the share price is, I think accessing capital, whether debt, and debt will always require some level of equity associated with it, is something that perhaps is going to be difficult for us to access. And I certainly think where the sentiment is with Trinity right now, that raising equity would probably be quite disastrous. So I agree that trying for us to move forward in Galeota is a difficult task. But I think nonetheless, Galeota represents a significant portion of our reserves and resources. Nearly 70% of the company's reserves and resources lie within Galeota, and it has the potential to be transformative for Trinity. Whether it is from us moving the project forward on our own, whether it is from us moving forward with a partner or outright sale, there is significant value within Galeota, and the board and management team are very much focused on continuing to invest in Galeota to get to the point where we have an investable project. At that point, we'll determine whether we can afford to move it forward on our own, whether on a piecemeal basis or not, or whether it is better to move forward with a partner or outright sell. But I think the focus for us right now is to continue the subsurface work on Galeota. We've described, what some of the conceptual, development cases will be. We are focused on looking at getting back into drilling low risk 2P reserves of existing infrastructure with existing export routes. So that lowers the project delivery risk and the subsurface risk. We are currently quality assuring that, as I speak, the team is focused on that. So I would hope that we can describe that project and provide scoping economics for that during the course of H1 of next year, and tell you why that is interesting for us, but also interesting for perhaps another partner, or if we get to that point, potentially moving that asset on for the benefit of shareholders. I'll move to some of the questions that we have received today, so just bear with me while I scroll through that list, please. A question here from Colin L is, shall we take it that BA will be your next drill? I think I've explained, from our perspective, PowerSeco remains a very interesting strategic option, and it has a number of short-term catalysts, whether it will be, the existing Jacobin well, what will that produce from the Lower Cruise 1 zone? And to remind you all that we drilled through 2 development zones. So there is the Upper Cruise and the Forest Sands within that well that will allow us, if the Lower Cruise zone, Lower Cruise 1 zone is not economic, we will move upward very quickly and start to produce from those and get payback on this well. If it is, however, that the investigator work determines that there's further reservoir to get after, we will add that into our opportunity hopper and see what that means in terms of risk and reward. Buenos Aires, we are looking at the seismic. We are coming up with prospects and turning those into drillable prospects. We are pursuing the environmental impact assessment simultaneously, and then therefore the certificate for environmental clearance. So we are building the options to drill in PowerSeco area within the next, I would say, 12 to 18 months. Whilst we are doing that, we will be replenishing the balance sheet from the existing production and the cash flow from there. We will get a significant boost from the change in SPT, if and when that is enacted. So you will see us for the next 6 months, not actually moving forward in terms of drilling plans, but taking that information, building the opportunity hopper, and then towards the middle of next year, you should be hearing from us, where our next well will be. But it could be very likely that Buenos Aires could be the next well that we drill. But stay tuned and we'll update you in due course. Next question is, how can we rely upon pledged regular communication when it failed again this month? I think we've been most active in the markets and coming to market, nearly every 2 to 3 weeks. So we've been guiding the market as to what the milestones are, when we would come back to market, and we've been adhering to those. In fact, when it came to the perforation of the Lower Cruise 1 zone, we guided that we'd be back, with investors to give news on that, in or around this time in December. We managed to, in this instance, beat the timetable there. And we've now done some well testing and we've updated the market on that. So, certainly from my perspective, we have been very frequent to market. We are keeping investors very attuned to what is happening with this Jacobin play. But the next steps are, once Jacobin is out, I expect that we'll go back into, routine operations. They will have the quarterly updates. We will provide a quarter 4 update in late Jan as guided previously, and the guidance for 2024 will also be provided within that period. I also expect that within January, we should get news on the SBT reform, and of course, we'll be providing information to shareholders on that, once we have full clarity that that has been enacted. There's a question, is the dividend which is payable in 2024 1.5p or 3p? As we guided, the dividend is 1.5p. 0.5 of that has been paid, and the remaining pence will be paid once the full year 2023 results have been published. Donald F asks, what level of production in BOPD would be needed to consider $8.3 million a worthwhile investment? Donald, you'll have to be looking at production from this well in excess of 400 BOPD. So right now, we are not close to that. So my view is, from the perspective of this well, we are probably erring more to the side that this investment is unlikely to pay for itself in a short period of time. It's probably going to take a long time because there is oil to be recovered from this well, whether it is from the Lower Cruise 1 zone, whether it is from the Upper Cruise, whether it is from the forest zones. This well will pay back for itself, but the time frame is going to be quite long for that to happen. So from that perspective, I can say geologically the model has been proven, but from a drilling perspective, we have had some challenges which have increased the cost, and then we have seen that the productivity of these zones, for one reason or the other, whether it is reservoir, whether it is mechanical, and what we're investigating right now, is pointing towards a well that's going to be, on the lower end of the production scale than sort of the mid to high range. There's a question here: is when will directors be purchasing shares on the open market to show their confidence and support in the company? Well, let me start from where we are. Currently, there are at least 3 directors who hold shares. So our non-exec chair, Nicholas Clayton, holds shares. James Menzies also holds shares within the company, and I hold a significant amount of shares in the company as well. Given what we've been going through with Jacobin, we have been guided by our Nomad that we are in an closed period, and therefore, as insiders, we are not allowed to trade. So we were just not capable of trading in the past. But also, in addition to that, as we subscribe to the QC, the Quoted Companies Alliance code, and that code is changing, and the change that has been mooted in terms of non-exec directors is that they should try to remain as independent as possible, and therefore minimize any exposure to the equity of the company to maintain independent thinking at the board level. So I'd expect that, whilst this is not yet enacted, and those changes are due to be enacted in April of next year, that's the direction of travel that you would see us moving towards. Nonetheless, executive directors such as myself, Julian Kennedy, and the remainder of the management team, a significant portion of our remuneration is based on the performance of the equity within the company. So we are incentivized alongside shareholders who are invested in the company to also improve the share price performance of that company. And those rules, those criteria are set out very clearly in the announcements that we've made as it pertains to the awards of long-term incentive, the long-term incentive plan. UD, what is Trinity's plan for financing the next round of drilling? Trinity can't afford another $8 million well through organic financing. Will you look to use your overdraft or raise money at 36p? Hugh, I've sort of set it out before, but I'll just like to make this crystal clear. Certainly, I think, within the next 6 to 9 months, you're going to see a consolidation from us in terms of information that we have gathered, in terms of being able to guide the decision-making on other opportunities to move the business forward. We are committed to putting a certain level of the operating cash flow that we generate towards growth of the business. But I would say in the next 6 to 9 months, what you're going to see from us is a consolidation in terms of the cash that we spend. We're going to try to maximize the amount of operating cash flow that we generate into free cash flow that would then replenish the balance sheet. You're going to see us looking at our cost structure, trying to make that even leaner than we currently are, and therefore drive the break even of the business down which in turn will do two things: make us resilient to low oil prices, but also in turn allow us to maximize the operating cash flow. So right now, I agree, we are not going to take on another $8 million well in any means. If we are going to look to use our overdraft is used primarily to match the VAT refunds that we have outstanding with the government. So as we invest, for example, Jacobin was a significant investment. There was VAT associated with that, and that meant that our VAT outstanding balance would have risen. You would see that the overdraft that we have will likely increase to match that VAT overdraft, so that we are using the working capital facility to manage that working capital exposure that we have there. But I don't envisage that we're going to use that overdraft facility to drill, and therefore use debt for any type of exploration type of drilling at all. And in terms of raising money, that's not on the cards at the moment. The plan is focus on the production that we have, minimize the decline, look at the cost structure, try and reduce where we can, maximize operating cash flow, and try to bring as much as that onto the balance sheet. Afan N asks, can you please comment on the share price performance? The company was buying back shares at ATP. What does the company think of the share price right now? Afan, where we are, the share price as it stands today, and I look at the market cap this morning, which is in or around 17 or 18 million US dollars. You compare that to our operating cash flow guidance for this year, and we said that that would be 12 million US dollars. So you're looking at in comparison to this year, and I expect that next year will be a higher operating cash flow. We are trading at somewhere in terms of market cap ratio to the operating cash flow of the business, somewhere between 1.25 to 1.5 times of our operating cash flow. We have demonstrated in the past that we are very good at managing the production declines. We've managed our cost structure and kept that intact for a number of years. Of course, post-COVID, we've seen significant impacts of inflation, but also we increased the cost. We increased the cost base to try and do growth projects like Jacobin and move Galeota forward. Right now, my view on the share price is that the share price does not reflect the fundamentals of this business by any means. And from that perspective, we are undervalued. But where we are right now in terms of making a decision to buy back versus return cash to shareholders through dividends or other means, I think those decisions are before the board right now, not the dividend per se, sorry, because that's absolutely set in stone. But whether we're going to return cash to shareholders, my advice would be at this point in time, I would like to see us replenish the balance sheet cash balance, and then from there make a decision and see where we are. But it is about being patient and focusing on the fundamentals of this business within the next 6 to 9 months. Nick G asks, should you not consider marketing Galeota for sale? I think I've somewhat answered this before, but in summary, yes, we will consider doing that. But where we are focused right now is making sure that we can describe a low-risk project from a subsurface, from a project delivery risk, working that project up, the scope and economics internally, look very encouraging, describing that to the market, and then, when we understand what the funding gap is required for that, make the decision as to whether we can proceed on our own, whether we need a partner or an outright sale, so that the shareholders can reap the benefits of those significant reserves and resources. Okay, there's one more comment here about the Cliff W that says, I was part of the QCA team who wrote the original QCA code, and we wrote that NEDs, non-executive directors, with skin in the game provides alignment with shareholders. We favored buying shares or being paid partly in shares, but not options for non-executive directors. I was in minority view in that I favored options for companies who are concerned to conserve cash for investment. Corporate governance codes are comply or explain. You should explain why you wish to align your NEDs with shareholders. Bruce Dingwall would not have now tailored to those woke governance ideas. I think what I've described is what the QCA code is and where we will need to discuss it's clearly very new in terms of the changes, but it's pointing in a direction of more independence of thought and removing groupthink from the board. So I think, it's something for discussion, but as described previously, two of our non-executive directors hold shares currently, and myself, I hold a significant amount of shares and have a lot of exposure to the share price in terms of long-term incentive program planning, remuneration plan, sorry. So I think, right now where we are, we don't have a full decision on that, but I expect the decision to be in favor of where the QCA code is going in terms of maintaining the independence of the nets. But once we've made that decision, we have our stance, we will update our quoted, our QCA feedback that we have on our website and update that accordingly in due course and let you know, which should be towards the middle part of next year when we produce our annual report. I think at this point in time, I would just like to, pause and in fact stop in terms of the questions that I've answered most of the questions. Any questions that we don't answer, of course, we'll provide feedback to those and post them up on the IMC website within the next few days or so. Thank you for your time. Thank you for your attention. Thanks for the questions, which were really helpful.
Perfect. Jeremy, thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Trinity Exploration and Production PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.